Hello, everybody. This week we discuss the worries and fears of the depositors of banks in India. On 10th June, State Bank of India advertised for the post of Chief Financial Officer at a cost to company annually 1 crore. This high salary is being offered for the CFO through the contract route. As a depositor, one wonders whether recruiting from outside will really add to the efficiencies of the system. Traditionally, the State Bank of India's probationary officers have been groomed into the various senior management cadres. One previous chief financial officer is the chief financial officer currently at the World Bank. So there is no dearth of talent in the State Bank of India within. Yet, in some comparison to the outside private sector banks, where they quoted that one of the CEOs was drawing a salary of 55 crores annually, annual compensation of 55 crores, and therefore there is need for market-based remuneration policy. This looks a little worrying as it adds to the cost structure of banks and ultimately affects the depositors. This is also sociologically not a good argument because this is a country where 30 million people live below the poverty line, and that is 32 rupees to spend in rural areas and 47 rupees to spend in urban areas. That becomes an annual income of just about 11,500 rupees, an annual income of 11,500 rupees in the rural areas and 17,500 rupees in the urban areas. Comparisons are odious, said Shakespeare. Milton said, they only serve who stand and wait. So the poor shall wait and we shall not compare, because the collectively powerful make a merry salary equality pitch. The second important development came from the Reserve Bank of India, which has a mandate to protect the interests of the depositors. On 11th June, the Reserve Bank released a discussion paper on governance in commercial banks in India. We need to draw the attention of the corporate governance principles to include the specific provisions to protect depositor interests more strongly. Why so? The depositors are the suppliers of the raw materials of banking. Depositors initiate the process of financial intermediation. Banks accept deposits and then transform them over time to loans, and they make their incomes, banks make their incomes in the spread. That's the difference between interest paid and interest received. India has rupees 135 lakh crores as aggregate deposits, according to RBI figures. Demand deposits are at about 14 lakh crores. Time deposits are about 121 lakh crores. For these depositors, what is of significance is that the repo rate cut between February 2019 up to March 2020 was 135 basis points. That is 1.35%. In 58 days after March, the Reserve Bank of India cut further in two installments, one of 7.75%, that is 75 basis points, and of another 40 basis points. So totally 1.15 cut after COVID and 1.35 in the previous years, totally 2.5% sharp reduction in the repo rate, signaling that the deposit rates must fall. The wise monetary policy has, however, cautioned that there is a likelihood of food prices increasing. So, what is the cumulative effect of this? The cumulative effect of this has been that the savings account has fallen to 2.7%. The deposit rates, fixed term, have fallen for 3 years to 5 years to 5.3% from 5.7% earlier. A 1-year FD will now fetch only 5.1% against 5.5% earlier. It is interesting to see how the lending rates, the Reserve Bank of India has released the lending rates of the scheduled commercial banks. The bank-wise weighted average lending rate was 9.89, and the bank-wise group average weighted domestic term deposit rate was 6.07. 9.89 minus 6.07 is a big spread. The housing loan can be obtained at 7.35, but an education loan can be obtained at 9.55% only. Consumer auto loans are given at 8%. So you are giving greater prominence to consumerism and consumer loans or personal loans at 10.5%. But education loans are at 9.55%. That's nearly 10%. So we need to rethink the policy in regard to passing on, and the Reserve Bank has a signal duty to protect the depositor interests because the depositors are fragmented, they are several, they are dispersed. So what can the Reserve Bank do? It must insist on total factor productivity in banks. The costs of funding are four to a bank. One, the cost of deposits or borrowings. That's the cost of funding. The second cost is one of NPA. If the NPAs of a bank rise, somebody has to pay the price, and that is a cost. Then there is the negative cost of the reserve ratios stipulated by the Reserve Bank of India. And finally, we have the negative costs of the operational and administrative establishment expenditure of the banks. And that is where the issue of high salaries to the top management cadres come in. Is this right? Earlier, when we had problems in 2008, people discussed globally about the compensation policies of banks. The Reserve Bank of India needs to take note. We cannot have the depositors pay for the inefficiencies in banking. We cannot have the real interest rates of the savers being disincentivized. Gross savings ratio in India declined from 38% in 2008-2009 to 29.5%, much below the Chinese rate of 44%. So if India expects to catch up, it needs capital, it needs somebody to save, and therefore there must be a lot of thinking, or rather rethinking. Banks must shed fat and be productive. It does not need, in this modern world, does it really need 145,000 brick and mortar bank branches? So RBI, we feel, as depositors, must periodically publicize productivity per employee figures, cost to income ratios, and non-performing asset figures, so that depositors know which banks are efficient and which are not. In a country of the poor, the bureaucrat and the banker must refrain from usurping any powers of the depositor. Thank you.